If you're a loan officer, mortgage broker, or anyone in the home lending business, you deal with homeowners insurance on every single transaction. And if you've been doing this for a while, you've had at least one deal where the insurance almost killed the closing. Maybe the quote came in too high. Maybe the coverage didn't meet the lender's requirements. Maybe the agent couldn't get it bound in time. Most of those problems are avoidable. My name is Jim Eddington. I run an independent insurance agency called Western Pacific Insurance, and we've been working with home lending professionals since 2003. The problems start with the loan officer not understanding what's actually happening on the insurance side of the transaction, not just checking the box that says homeowners insurance obtained. Most loan officers treat homeowners insurance as a late-stage checklist item. The borrower gets a quote, the deck page gets uploaded, and everyone moves on until it doesn't work. Here are the scenarios that derail closings. The coverage amount doesn't meet the lender's dwelling requirement. The borrower got the cheapest quote they could find, and the dwelling limit is below what the lender or investor requires based on replacement cost. Now you're 3 days from closing and the borrower needs a new policy. The deductible is too high. Under Fannie Mae and Freddie Mac guidelines, most lenders cap the allowable deductible at 5% of the dwelling coverage amount. Some borrowers pick a high wind or hail deductible to save on premium, not realizing it violates the lender's guidelines. That gets caught at underwriting review, and now you're scrambling. The policy effective date doesn't align with the closing date. If the policy starts after the closing date, or if there's a gap, the lender isn't going to be able to fund. The named insured doesn't match the borrower on the loan. If the named insured doesn't match the people holding title, the lender or closing team will reject the evidence of insurance. The agent has to correct and reissue. The mortgagee clause is wrong or missing. Most lenders and servicers have specific mortgagee clause instructions. If they're wrong or incomplete, the evidence of insurance gets kicked back and you're making phone calls instead of closing. You've probably seen files get hung up inside 48 hours of closing over nothing more than a bad mortgagee clause or a wind deductible that violated investor guidelines. Every one of those was preventable. This is a concept some loan officers don't fully understand on the insurance side, and it causes confusion on many transactions. The home's market value, what the borrower is paying, includes the land. Insurance replacement cost does not. Insurance only covers the cost to rebuild the structure. On many conventional loans, that means the dwelling coverage has to satisfy investor rules based on the cost to rebuild, not the market value and not the land. So when the dwelling coverage comes in lower than the purchase price, that doesn't automatically mean the policy is wrong. Understanding that distinction prevents unnecessary panic. Not all insurance quotes are created equal, and this is where lending professionals need to pay attention. A properly underwritten quote means the agent has already verified the property details with the carrier. The roof age, the construction type, the square footage, the location risk factors, any claims history, and any condition issues. A properly scrubbed quote is far less likely to change at the bind stage because the key underwriting issues were addressed up front. Some agencies quote fast but don't fully underwrite up front. The borrower gets a number, the lender sees a deck page, everyone thinks it's done. Then at binding, the carrier pulls the actual property data and the rate changes. Or worse, the carrier declines the risk entirely. Now you're 2 days from closing with no insurance. A fully underwritten quote takes a little more time on the front end, but it means binding is fast, sometimes under 15 minutes, because the carrier has already approved the risk at the quoted price. For a lending professional on a tight closing timeline, that reliability is worth far more than a quick quote that falls apart. This is something every lending professional needs to understand. A split premium is when an insurance agent breaks the annual premium into 2 payments to reduce the amount shown at closing. The closing documents reflect a lower number than the actual annual cost. The lender funds based on that number. The escrow account is set up based on that number. But showing a lender a lower insurance number than the borrower is actually committed to is exactly the kind of shortcut that creates escrow shortages, payment increases for the borrower within the first year, and a regulatory risk for everyone involved. A clean transaction uses the full annual premium. If someone is intentionally understating the true premium obligation to make the deal qualify or reduce cash to close, that's not a creative solution. That's a serious misrepresentation and compliance problem. Installment billing can be legitimate when it's properly disclosed, but showing a lender a lower number than the borrower is actually committed to is exactly the kind of shortcut that creates escrow shortages, payment increases for the borrower within the first year, and a real regulatory risk for everyone involved. A clean transaction uses the full annual premium. That's what goes into escrow. That's what the lender should be underwriting against. If you've been in lending long enough, you've had a deal where the flood determination came back in a flood zone and nobody expected it. Now the borrower needs flood insurance, which adds cost and time, and the closing timeline is at risk. The best practice is to run the flood determination early in the process. Don't wait until the week of closing. If the property is in a FEMA special flood hazard area, flood insurance may be mandatory depending on the loan type. Now the borrower needs a separate flood policy, which has its own underwriting, its own timeline, and its own premium. Give your insurance agent enough lead time to handle that. Even if the property isn't in a flood zone, it's worth having a conversation about flood coverage. Many properties that aren't in a designated zone still have meaningful flood exposure, especially in areas prone to flash flooding or in states where drainage infrastructure is limited. One thing most loan officers don't realize is the lever they have in this process. If the borrower's current insurance agent is slow, unresponsive, or delivering quotes that don't meet lender requirements, you don't have to wait. You can request a competing quote on the borrower's behalf with their knowledge and consent from an agency that understands closing timelines. The borrower benefits from better pricing, better service, or both, and your closing stays on track. If you're currently referring borrowers to an insurance agent or working with one regularly, here's what you should expect. A fully underwritten quote delivered within a reasonable timeline. Not a placeholder, not an estimate, a real number that's unlikely to change at binding unless new underwriting information surfaces. A clean evidence of insurance with the correct mortgagee clause, correct effective date, correct named insurance, and correct dwelling coverage the first time. Responsive communication. When you need a correction, an endorsement, or a rush bind, the agent picks up the phone. Closing timelines don't wait. And no shortcuts. No split premiums to make the deal work, no underinsuring the property to hit a lower number. A good insurance agent protects the borrower and makes your closing smoother, not harder. If you're a mortgage professional and you want to work with an agency that understands lending timelines and does insurance the right way, just send over your client and property info to service@wpinsure.com. And if you'd like us to reach out to them directly, just let us know. In most cases, we'll turn around a fully underwritten, bindable quote in half a business day. We've been working with home lending professionals since 2003. We serve borrowers across Nevada, Arizona, Utah, and California, and we don't drop the ball at closing. Thanks for watching.